Psychologically, they just act on it differently. The second thing about misconception is the methods that they use. I often find that beginner traders think of traders out there as people who have a very sophisticated method, many variables to it. But I find that successful traders have narrowed it down to a very small number of variables. And this is basically what they go with. I think that beginner traders, as opposed to very experienced and successful traders, they try to have many charts, many screens, many platforms, and they think that that will all lead to success. But the reality is the successful traders that I saw and have met over my life, they use very simple methods, and they actually very proud of it. They don't say that they use sophisticated methods. They say we use simple things, it works for us. But I would say that they also have a very strong sense of risk management, meaning that regardless of the methods that they use, they know that many times they're wrong, and they have the ability to absorb losses and move on. And that's a very important trait in a successful trader, meaning that he has the ability to be hurt many times and not stop and continue doing it, and you know, day in and day out. I would say that most people, unfortunately, cannot do that. And when they experience a sequence of losses, they freeze, which is really understandable. After all, money doesn't grow on trees, and everybody has only a certain level of risk capital that they can apply to in their lifetime or during that year and so forth. So I would say risk management, the ability to, again, you know, absorb losses in a sequence of months, and still continue with the method that has been successful to them.
Okay, so a couple things just off what you've said there. The traders you're referring to who kind of have the approach that less is more, do you find that these are a certain type of traders, as in the, you know, short-term discretionary traders, or the, you know, maybe trend followers, like, or are you talking about traders just in general?
I would say that it's in general, you know, whether they use a long-term approach or a short-term approach, it still has to be simple. Now, I want to emphasize one thing as well. When I say simple, sometimes it took them years to get to that simple, meaning that, you know, maybe they started off with a lot of variables and a lot of, you know, a lot of indicators and a lot of other things that basically thought would help them. But at the same time, over time, they kind of, you know, saw that certain things really just mislead them or they don't help them. So they simply narrowed it down. But one thing I wanted to say is that every single trader that I've met, every single one uses a different thing. I've never met one trader that has been doing this for a very long time successfully, and he's using something very similar to someone else. And that, again, leads me to believe that there is something in their nature that allows them to operate in this environment using the tools that they feel comfortable. So I don't necessarily know if it's always the tools that make them successful, but I think it's more than anything the risk management that they apply to it in terms of trading. I would actually, the people that are beginners always ask me, you know, what do those successful traders do? And I tell them every single one of them is different. And this is what I really wanted to convey to a lot of people that are listening out there. You know, you shouldn't really try and imitate anybody else's style and ask them what they do, but instead, you know, build your own and something that you feel comfortable with. You feel comfortable with the entries, the exits, and the risk management.
Right. So the second part I wanted to pick up from, and that is you spoke, you know, quite a bit about actually methodologies and, you know, a good sound approach. So how should traders go about developing their own methodologies? Like, what's your opinion of a good approach?
Well, first they have to understand how the mechanism of the marketplace works. I find that a lot of people would jump to technical analysis or price action or quantitative analysis, all those things, but they really first have to understand how the market mechanism works, meaning how buyers and sellers interact in the marketplace. And so, for example, how limit orders are being absorbed, how market orders are getting executed, and so forth. So this whole interaction of buyers and sellers, and it's really easy to learn because there's a lot of stuff on it on the net today. The second thing I would say is really look at their set of their skill set. You know, what are they good at? Are they good in, you know, visuals? For example, I find that I spoke to a few traders over the years that are very good in recognizing patterns on the charts. Some people are extremely good in terms of knowing how to read indicators, right? Some people like to apply things that are in math, you know, mathematical analysis or statistical analysis. I would say for majority of people, first observe the markets, observe the patterns that the markets are operate within. Narrow it down to a small number of markets. If you're a futures trader, you can focus on something, for example, a very liquid market like the E-mini S&P. Although it's a very difficult market to trade, it has a lot of liquidity, it moves in certain patterns and so forth. If you want something a little bit different with, let's say, different type of leverage and movement, you can look at the 10-year notes and so forth. And once you learn the leverage that each product has, you can choose the one that is appropriate for you. So let's say maybe you're not comfortable with the movement of the E-mini S&P and the range throughout the day. Maybe it's just too much for your nature and your risk capital. But you may find that the 10-year notes, the movements is a little bit narrow. It's something that you can live with. So that's the first thing. The first thing is really to choose the markets. Once you choose the markets, then, you know, like I said before, choose the methodology you want to apply. Look at the visual displays. Play around on every platform. You have so many indicators and technical analysis that you can apply and learn each one of them and what they do. You might not use those indicators, but by learning them, you will see what they're actually, what traders are actually looking for. And that could evolve to other things and so forth. The third thing that I would do is really learn about cash management. It is, we can talk 2 hours about that topic in itself, but recognizing, I should say, when you're wrong is the key. So before you start trading, and if you've traded for a number of years, you have to develop a method that tells you when you are wrong. That the reason you get out of the market is because the set of conditions that have made you get into the market is no longer there. So a lot of people can use risk management that is financial, but it's better, in my personal opinion, to have a risk management which is based on price rather than just money. But essentially the risk management, regardless of the methodology that you use, would be a key component of your trading, recognizing when you're wrong. Because I've seen situations, and it's kind of unfortunate, that people have eliminated an entire account because they were hoping that the price would come back. So we both know that psychology is a big component of the market, but the last thing you want to resort to in trading is hope. Everything has to be based on something. So it has to be based on the methodology. So again, the last part that I emphasize is the risk management, knowing when you're wrong and getting out of it.
Excellent. Okay, Matt. So bringing it back now, I asked you about what is the makeup of a good trader. On the other hand, what makes a quote unquote bad trader?
Well, I wouldn't call anybody a bad trader, but I would tell you that there's different traders in different stage in trading. I mean, they're at a different stage. So when they start, I would say that even the best traders out there have lost money in trading in the early years. I think it's just you pay tuition to the marketplace. But I would say this, you can define a bad trader if you have the wrong motivation. If you're in the marketplace, to pay your mortgage and to create additional income when you shouldn't trade, it's really going to be reflected in your trading. I would tell people this, that any type of instrument that uses leverage, whether it's futures or Forex, or if you trade stocks on leverage, on margin, or option trading, they basically, your psychology will be affected by your motivation. So I would say to those traders who have really strong curiosity of the markets to learn in the first years and not trade. And basically, as they say, scared money never wins. So going back to the traders that are trying to be successful, and they're at a different stage, and the things that they don't apply out there are risk management. The second thing that they do is that they think that there's a method out there, some mystical method that they can just copy and be very successful with it. So they can look at a successful trader, take out what he does and simply imitate it, when in reality it's not true, because the risk management component, that's what makes them successful, I believe, not necessarily the method. The third thing that I think they do is that they change methods all the time. So they move from one method to another method to another method. And another thing, a misconception among traders that are not successful, is that they think that there is some sort of a consistency in the marketplace as far as returns. So they think that a trader, for example, can open an account with $10,000 or $20,000 or $100,000 and generate, for example, 5% consistently every month. If you look at the returns of successful traders, you can always make an average after many years of trading, but I would say that the average is very misleading. I would say that they go through a sequence of very good months and very bad months in the hopes that in the end they have a positive year, but they don't operate on short-term basis, and they don't expect cash flows to be generated on a monthly basis. And a lot of beginner traders, for some reason, have this belief. I would say that even when I try and convey this message to many traders, a lot of them don't believe me. They think that there is some sort of a magical method out there that makes the same return every single month. If you look at successful traders or anybody with a long-term track record, and I mean 15 years, 20 years, and so forth, it's quite interesting to see their returns and their drawdowns. And I think that traders, beginner traders, should start looking at those returns to see what they should expect. I truly believe that part of my job as a broker is really to inform people of all the knowledge that I have, in the hopes that if they see it, they will also approach the markets the right way. I think that if they look at those kind of stats, it would kind of change their approach, and hopefully for the better.
Yeah, so that's an interesting topic that you bring up there. And I mean, we could probably spend quite a lot of time on this. And that's, what's a decent return that you could expect? Like, when could you, how do I say this? Like, if you look at the big guys on Wall Street, right, they might return, 20% a year, and that's considered as like exceptional, okay? If a smaller retail trader, maybe trading a $10,000 account, returns 20% in a year, chances are they're not going to be satisfied. What's the difference there? Like, talk to us a little bit about how traders should think about that.
I think, if somebody has the ability to return 20%, I think it's a great return. This is just in my personal opinion, considering that the interest rate environment today, although we had a hike in the rates, with just quarter of a point, I think 20% is great. I wish I could answer that question and say what traders should expect. I think they should expect returns that are based on their skills. Some people will have more and some people will have less. But I have encountered people, for example, that would throw $5,000 or $10,000 into an account, and their question to me is, can I make $200 a day? And usually that's followed by, I'm not a greedy guy. I just want $200 a day. And my answer to that is greed. The minute you come to the marketplace and you say, this is what I want, whether it's 200 or 500 or 1,000, is definitely the wrong approach. Now, if you consider annually, $200 a day and something like 5,000 or 10,000, that's an abnormal return. I don't think people should expect it, especially when they're beginners. What they look at is the volatility of the market. And so they would look at something like the E-mini S&P, right? And they would see a range of 40, 50 points a day, or sometimes 20 points a day. And they would say, this is very achievable to extract only 4 points out of the market. But I think it's very deceiving to look at the markets this way. I think that what they don't have in terms of calculation, or one of the variables they don't take into consideration, is really the psychology that it takes to be successful in the marketplace, how you monitor and how you control the emotional volatility that comes with the markets. So honestly, I cannot in good faith say what traders should expect. I would say that it's based on their skills, the risk that they take with each trade, the risk capital that they have, and so forth. So different traders will experience different things. But I am very comfortable saying that if traders in the first year just survive, meaning that if they do things right and they don't lose their capital in the first year, I would say that, in my personal opinion, they may, and again, I emphasize, they may have a chance, in the years to come. This is only an opinion. This is my opinion, but I think this is what they should strive for. I think that most of beginner traders should expect, some sort of losses in the first years or months. And the reason is because that's just the marketplace. They have to learn how to control their emotions, develop a methodology, and so forth in the marketplace. A lot of people try for many years to paper trade before they come into the market, and they develop certain expectations from their paper trading to be applied in the marketplace. But a lot of people think I would say that because I'm a broker and I have a motivation of getting them started in trading. But nevertheless, I'm going to say it, that whatever you perform in your demo account, when you don't have skin in the game, it's a completely different thing. You will behave completely differently when you're in the marketplace. Also, and I know it's a little bit of a different topic, but nevertheless, people develop expectations of return based on their demo trading. And I would say that whatever happens in your demo, as far as your orders getting filled and the number of contracts that you trade and so forth, are very different than what you'll experience in real life.
Yeah, and just, further thought on that is like, the big hedge fund managers who are managing, billions of dollars, like literally billions of dollars. If they make a return of 20%, is that fair to compare someone who's trading maybe, a $10,000, $20,000 account? Is it fair to sort of compare their returns side by side? Like someone who's trading, $10,000, $20,000 account might make a 20% return in just a couple good trades. So can you really sort of compare your returns amongst the big boys?
Not really. In my personal opinion, hedge funds, for example, they trade a lot of money, and it's much harder to trade larger sums of money as opposed to small sums of money. And I think there's also a different set of politics with hedge funds. They have big customers, and I don't think they have certain rules and regulations as far as the risks that they can take with their customers' capital. Now, a small trader, on the other hand, might take, let's say that he'll take 3-4 gold positions, and gold will jump up, let's say $20 in a day, and he potentially could double his account, right? So on that trade, he achieved a lot more than what a hedge fund achieved in a year, and he might feel very good about it. But here's the most important thing. The most important thing is consistency. It's what you can do consistently, and not necessarily look at it at a retail trader that just does a small number of trades and becomes very euphoric about it. This is just my opinion. So I don't think you can compare between the two. And I think people who invest in hedge funds, they have totally different expectations that somebody who's a trader. We're talking here, in my personal opinion, of an investor that is used to certain market returns versus a trader that might expect a lot more because he's taking a lot more risk with his capital.
Right. So I guess the point I'm sort of trying to get to is that for an independent trader, it's not necessarily greedy or unreasonable to expect returns of much greater than 20% per year.
I would say it depends on their skill. I'm not really comfortable telling anybody, a certain return. I would say everything is based on your skill, how many years you've done that, the risk that you take with every trade, and so forth. There are individual traders who make more than that. There'll be a lot more individual traders that make less than that. But again, it boils down to their skill. The question that you asked me is a very reasonable question. I really am asked a lot by people, what should I expect? What kind of returns should I expect? And it's very hard for me to tell anybody what they should expect, because it really depends on their skill. I think that nobody should come to the market with any expectations of return. I would say, I feel very comfortable saying that. I think that you should just focus on your method. The minute you start focusing on returns, it's a totally different thing. And I think it's in a leverage environment like futures, I don't think you should apply it. Maybe in other asset classes, you can build strategies, that would give you that. Like in bonds, there's fixed returns, dividends from stocks, and so forth. When you trade in a very leveraged environment like futures, that entails a very high risk of trading, I think your most important focus should be your method. And what it brings you, it brings you. That's really what it is. I think that's what successful traders also do. They could also think about this. Let's say that you got to the point that you're a successful trader. So a lot of beginner traders think, well, why don't successful traders just trade triple or quadruple or at least double the positions that they have if they're so successful, and then they'll make more? But the answer to that, the reason they don't do that, is because they're used to a certain level of risk that they're comfortable with. The second thing is, the more risk you take in a trade, in any given trade, it will affect you psychologically different. So maybe some traders can, for example, be successful with one lot, which is absolutely fine. But the minute they go to 5, they just kind of, they're in a different state of mind. Or somebody got to the point where they trade 10 contracts, but if they want to trade 20 contracts, might be too much for them. The fluctuations and the leverage and the effect on the balance could be a little bit different. So again, the focus should really be on the method itself and the application of the method to the best of a trader's ability without thinking about returns. And hopefully good things will come out of it.
Sure. Okay. Yeah, no, that's a valid point. So let's keep this moving. Next question here I've got, I think you're going to give an interesting answer to. In your opinion, how does trading differ from gambling, if at all?
They're very similar in many ways. Both involve psychology. Those who are poker players, you know, they have a bankroll, and any gambler would tell you that bankroll is extremely important, just like cash management. So in many ways, there are a lot of similarities, and you can actually learn from them. So one of the things that anything that involves psychology and odds has, those are things that have things in common. So when you place a trade, you have certain odds, you have a certain psychology. When you gamble, you have a certain psychology and certain odds. So I would say there are similar things between any method, and you double down, you know, where you get into, when you lose, or you get into revenge trading. This is also a form of gambling. So I would say that, you know, when you think about those two things, I don't think you should right away dismiss that trading doesn't have any gambling components in it. I think it's important to realize that both involve very strong psychology, cash management, and so forth. But of course, I think that trading is done in a better environment, in a regulated environment. Casinos are private, and you know they're interested for their customers, you know, to lose. That's how they make their money. I think the exchanges, on the other hand, the regulation in our industry provide more of an objective environment for the trader. And you know, in a place like an exchange, you just exchange opinions, right? So somebody's long, somebody's short, and so forth. And somebody will be right at the end of the day. But the exchange doesn't have a vested interest in somebody, you know, losing their money. So I would say that trading provides a better and a more objective environment, you know, than a gambling environment.
Yeah, I really like that answer, Matt. And the reason I asked that is because there's a really great article you have on the Optimus Futures blog. So I'll link to that if anyone wants to, you know, read more on that subject. That'll be at chatwithtraders.com/56. So one other thing I wanted to ask about, obviously amongst many, you often hear established traders and the guys who have been around the block saying professional trading should be boring. Are you able to elaborate on why this should be the case?
Yes, it's actually a very good question. Trading at the end of the day is successful trading, I should say, is boring. And I'll tell you exactly why. Once you build a method and the method is successful, you really have to wait for the times to apply it. And the market may take some time until it provides you with this opportunity. So even if you're a day trader, it doesn't mean that you have to trade every single day. Maybe the method that you build is a day trading method, but it only applies once a week. Maybe there was 1 week that every day provided that opportunity. But at the same time, you have to wait until the market forms to give you this opportunity and apply your method. It has to be done under certain market conditions. And this is why I say trading is boring, or successful trading is boring, because most of the time it requires traders to sit and wait until the market presents them with this opportunity. Unfortunately, it's human nature. People get bored, so they don't want to miss on an opportunity. So again, you know, they use a lot of hunches and gut feels and, you know, newsletters and forums and other forms of communication that encourage them to be in the marketplace. But I find that those people that are patient, they wait for the right opportunity, and then they apply it, I think they have better odds than somebody that looks for excitement in the marketplace. And that's, again, why it's boring, because you have to wait for the opportunity to come. And those people, they just learned, that this is what it is. They just sit, they wait, the opportunity presents themselves, and then they apply it. And even then, they know that they still have to control their risk management, and they have to apply regardless if it was, let's say, somebody trades price action and that certain formation was formed and they apply, they still have to apply the risk management to it, in order to be successful in the long run. And the one thing that I would like to add, this is really important to understand. We were talking before about successful traders and everything else, and you asked me about gambling as well. And, there's one thing that is still could be very, very common. You could do all the right things. You can do every day the right things according to your plan, and the market just doesn't return anything, or actually doesn't play along with you, or where you lose money. So you do everything right. And this is also what traders have to understand. There could be days that they do everything right. They were disciplined, they waited for the right opportunity, they applied the risk management, and still they were not successful in the trade. And this is what successful traders have learned also to live with time, is that the fact that they can do everything right and still be wrong. And this is something that majority of the people will not want to do or admit to, that they actually could do everything right and still have unsuccessful days. So that's important, to understand. And the reason that I'm sharing it with everybody is, God forbid, not to discourage anybody from trading, but rather I think that, if you're prepared right, if you know all the facts, one thing that I try to do with my customers is really give them all the facts up front, and be honest with them about it. And I think if you provide them with the right facts, I think that a lot of people will make the right decisions along with it.
Yeah, that's a brilliant answer. And I like the part where you mentioned that even if you're a day trader, that you don't have to trade every day. And it kind of reminds me of a point that Cam Data, who I know you're very familiar with, mentioned on a previous podcast. And he spoke about how, there's some days where he might sit in front of his screens for 5 hours and not even place a trade, just because he has a very specific framework for how he trades. And if the market doesn't align with that, then it's a no-go. So
right.
It's a solid point. Now, another question I'd like to put to you is, why do traders many times find themselves repeating bad habits and lacking discipline?
Well, let's go back and talk about what we spoke about earlier about, people who approach this game who were successful before. They're used to discipline. Most people are not used to discipline in their day-to-day life. But I would say that there's this concept of hope. And I think that people have to separate between hope and habits. And I'll be very specific, and I'll answer your question. So a lot of people say, just this time. The reason that they repeat the same mistakes over and over again, they say, just this time. I'll give you an example. Let's say somebody gets into a bad trade and it goes against them, and then they add money and they add money and they add money and they blow their account, right? And so that experience is done. And then let's say they refund their account. So now the same situation, and what they say to themselves, just this time, and if I recover, I won't do it again. So they're always in the business of convincing themselves that they will not do it again. The reason that they lack discipline is because they're hopeful. When there's a certain level in the marketplace that even if you're very, very disciplined, and it happens to a lot of beginner traders, they throw everything out the window. Everything that they've learned, everything that they've applied, they just kind of throw it out the window in the hopes of recovering big losses that have occurred. So I would say that many traders are not disciplined, I would say because they're not used to applying a method consistently every day, they're not used to the fact that you have to wait for the market, for the opportunity. They always think they're going to miss out on things. And at the same time, they're in the psychology is in such a way that they hope to recover from losses, and they keep on repeating the same mistake over and over again. Over the years, I've read a lot of articles about psychology and trading or just human psychology in general, and motivations of people can vary from one person to everybody. I can't say that I have expertise in behavioral finance, which a lot of those people, their psychology falls under. But I would say that hope to recover from losses is probably the number one thing where people, this is the area where they stay undisciplined. They hope to recover losses that have occurred in the market. And when they try to do that, even worse thing happened. The one advice I would tell people is basically, again, risk management. Stay focused on that. That is your number one priority. And I'm not saying that you should be proud every time you take a loss, but at the same time, you can say to yourself, you know what, at least I applied it and I applied the risk management. And you just keep on doing it in that pattern. And hopefully that would lead you to better and positive results.
Absolutely. Yeah, well said, Matt. I think that was probably a little bit of a tricky question, but I think you nailed it. So now it makes sense that I ask you a few things around brokerage while we have you here. So this may be almost like a two-pronged question, but answer it however you see best fit. So what are some tips and pointers traders should consider when deciding on a broker and a platform?
I would say when you choose a broker, you choose somebody you get along with, you choose somebody who's competent, and somebody who can give you very objective answers that are based on your situations. Now, times I am faced with situations with, for example, potential customers that come to us and they request certain things and so forth. And what I try and do is not necessarily discourage them from what they do, but rather show them a different thing that they can utilize in their trading, whether a different technology or they've read something online which I don't think is right and so forth. So to answer your question, a broker that is objective, a broker that understands what you're trying to do and apply and offer you the right technology with it. Now, as far as the choice of platforms, how do they go about choosing the technology and so forth? I would tell you this is probably the most overwhelming area for traders. I would say that some are stuck for months, if not years, trying to choose the right platform for them. And I would say that, just choose one and just start. Honestly, might not be what you're looking for, and you'll have to switch later on. But at least by working with a platform, at least you'll see what you get out of it, and it might fill all your needs. So I would say it requires a little bit of research as far as your method. But I find that most of the platforms today that are provided by the big companies that we represent would cover probably, I would say, 80 to 90% of customer needs.
Okay, and you might have to correct me on my terminology here, but what are some of the big differences between your typical retail, your online brokers versus your more professional brokers, like yourself?
I'm not sure that there is a big difference because, what we do, if you're talking about the big wirehouses out there, then they also, we're in the same marketplace. So they have a platform and they kind of, I would say, have, their technology and they represent it. And then there's brokers like us, and we represent our technology. In terms of operation, I think we're more of a boutique. So they're very big. When you call in, not everybody might know your name or what you want to do, or there might be a lot of departments. We have more of a personal relationships with our customers, and sometimes we provide the same type of technology, if not better. The big houses out there, they usually have one platform and they push everybody onto their platform. Because we are an independent introducing broker, we have the ability to offer different people, to offer different traders, different technologies. Some people might come in and say, look, I need something very good for option analysis. I'm a writer of options. Or somebody might say, look, I'm using market profile. What do you think is better for that? And also, one thing that it's important to remember, and this is something that you only learn over time. When you shop around, you really have to understand the technology that is provided to you. It's not all the same. Many years ago, when we started implementing more and more and more online trading, I found that there could be really big differences in terms of technology and execution. So what you should strive to have, it's some sort of a data feed that works with your platform, which is low latency. So that's basically, the thing you should strive for, something that, delivers your orders really fast. So I would say that boutiques, in my personal opinion, boutique firms like us may give a bigger option to a trader as opposed to just pushing one platform. We have over 40. So I think this is where we have the advantage. Now, where they have the advantage at times is basically in areas where we're not licensed, for example. So you might find that they have one platform for stocks, options, futures, all intermingled into one. And this is and for some traders that's important. For those who are focused on futures specifically, I think this is where we have the advantage.
Okay. So just to summarize, it would be essentially, I guess, the technology aspect is much more flexible in which platform you prefer to work with, as well as more personable on the support side of things.
Correct.
Okay. So following on from this, again, a very open-ended question, but what should an active trader consider or think about when it comes to commissions?
Well, commissions are really important because they're basically a cost for every single transaction that you do. And essentially, what you should look at from a cost perspective is a number of things. One, it's to see what kind of impact it has on your trading overall. So for example, if somebody's very, very active, it would be really foolish, to pay, let's say, above average commission or above average what the standard industry offers. So you have to see what impact it has on your trading. If somebody, on the other hand, trades once a day or once a week and it doesn't matter, and then that's where it's not important. But there's always a price war between brokers. You really have to decide who provides you with the best service at a given price. We try to be very, very flexible because clearly if somebody's a very active trader, I don't want the commissions to eat, if he's a successful trader, the majority of his equity. So it's important to be very, very flexible in that area in order to retain long-term customers. But if I was a customer, I would see, number one, the competence level when, for support, technology, making sure that it's always working and so forth. And also, it's important to talk about the one-off things, right? So for example, what would happen if your internet fell? That's not a commission factor necessarily when you trade, but that one-off thing, you have to be sure that your trading broker is available there, or the FCM that you work with is there to help you offset the risk when you're in that position. So those are the things that you should cover. So again, it's technology, price, support, and so forth. And again, that all stems from your level of trading. You have to look at the volumes that you have and to see what kind of impact it has overall on your account. You may find that you might be with a broker that you pay him just a little bit more, but at the same time, it doesn't have any serious impact on your trading, and you have a good relationship, and you have a technology that works. Now, you may find that sometimes, you know, the impact of the commissions due to your frequency of trading, and I have to admit that some day traders, they generate a lot of trades. Some of them are scalpers, or they go for a small number of points, and they might do it with a large number of contracts. So that has an impact. So it's important to negotiate those things with the broker. And I think an experienced broker who doesn't think short term should be very accommodating.
Let's just take a moment to thank our sponsor for this week's episode, who is Trading Technologies. So if you actively trade futures, then I'm speaking to you directly. TT from Trading Technologies is a superior platform well worth considering. Tools and features include Go Anywhere workspaces. So this allows you to save your workspace and pick up directly where you left off on any device, whether that's a multi-monitor desktop or a mobile phone. Real-time charts. This includes a range of style types and indicators with years worth of historical data, plus you even have the option to create your own indicators. ADL is the Algo Design Lab, where you can build and test your own algorithms with no manual coding required. Server-based execution. This means you get ultra-fast execution speeds using Trading Technologies' high-performance co-located network. So to learn more, visit trade.tt now and sign up for a free trial. All you need is an email address to get full access to the new TT platform from Trading Technologies, and it'll take you no more than 30 seconds. So go ahead and visit trade.tt now for more info. So I guess that's something I'd like to ask you about is, you know, typically speaking, how negotiable is the amount of commission a trader pays to their broker? Like, especially if they notice that their commissions do have quite a big impact on their trading performance. Like, you know, how do they go about that? Is it an option to negotiate with every broker, or are there certain brokers where you can and can't do it?
I can't speak for other brokers, but I would say, you know, for example, in our brokerage, you know, I believe it's the same case with other brokers as well, although I don't know for sure for every broker, but I find that most people are negotiable. If the trader is able to demonstrate that it's really having a serious impact on his trading, you know, then basically, you know, everybody should be negotiable. However, you know, sometimes there's only so much a broker can do in terms of commissions, because a lot of the commissions are built of other factors. They're built of for example, what the exchange charges. So they have a fixed cost, they never change it. Then you have the routing fees. So depending on the technology that you use and the platform might have a routing fee, which they incorporate into every single transaction. That's what they do. And sometimes the cost from them could be much higher than the cost of the broker. So sometimes it's the negotiation part is not only done with the broker, but the broker has to negotiate with, you know, the technology and say, look, I have customer, it really trades a lot. It would be in our best interest, you know, to lower those costs in order to help the customer. And, you know, I know there's a certain kind of misconception about brokers that we really want to squeeze the most out of people, but I find that professional brokers, even other friends of mine who are my competitors, but nevertheless colleagues, that's not the way that we think in the industry. We really try to, and I'm not the only one. So I don't want to say that I'm the only righteous brokers. There's a lot of good brokers out there who really understand the needs of the customers, and we try our best to help the customers and still at the same time have some sort of an integrity behind pricing. Sure.
No, that's really good to hear. So Matt, still on the topic of brokerage, I think it's still relevant and ties in, but slightly different. So you've been in the business a long time, right? What are some of the great differences you've seen when comparing, you know, the younger generation of traders to the older generations of traders, especially with the introduction of online trading, paper trading, and the different sort of tools and platforms that are now available? Like, what are the great differences or challenges between, today's generation and, the generations who have been trading for many, many years?
That's a really good question. There's a lot of things that I can tell you about both the brokers in the industry that have changed and the customers that have changed. When I started in the industry, majority of my time was actually spent on analyzing the markets. So I would say that once a week I would sit and look at the markets and what happened. And since most of the business was done over the phone, I would discuss that with the customer. Those things rarely happen today. I mean, here and there you might talk to a customer in general about trading and about the markets, but it was not as specific as it was before. I would say that before also people have not traded as frequently as they trade today. I think today, because they sit in front of the screen and they see the movements of the charts and the prices, I think it also affects their behavior. So before, the old generation, in order to get quotes, you really had to pay a lot of money. And it basically economically was not worth it. Today, it's practically, free. With the exception of a few, fees you have to pay to the CME or other exchanges. For the most part, it's really nothing, in my personal opinion. So people trade a lot more frequently today. Today, us as brokers, we're really turned more into consultants of software, not markets. People don't discuss with us markets anymore. And I'm not saying it's good or bad. I'm just saying that's just the way it is. There's so much information out there today that is free, from personal blogs to forums to big news outlets that write articles by the minute. The amount of information is out there is incredible. So the old traders were more focused on, I would say, back in the day, on longer term trends. They would take one trade, here and there, focused on longer term. Today, because of the commission cost that has been reduced substantially down, and because of the access to the markets, the ability to deliver orders so fast, the amount of trading is increased from the younger generations. I think they're more focused on shorter term trading, from scalping to day trading. And I find that people that are focused on long-term trading are just less and less and less. Also today, people trade a larger variety of markets. Back in the day, people would need to follow a certain sector, like they would follow the grains or the metals. Today, people trade everywhere. Anything that moves, and in different exchanges. They can trade the E-mini S&P during the day, and at nighttime, they might turn onto the Eurex and trade the DAX market. So the reality of it all is that the trader has changed substantially, his nature, what he's looking for in a trader, and the the brokers have become more of technology providers. And that's what we do. We're just in the business of kind of technology and commissions.
Okay. And just while we're on this subject, what tips do you have for traders going from a demo account to live trading? You touched on this a little bit earlier, but just, what tips and pointers could you give to someone who might be making the jump?
Okay, well, before they even make the jump, I would say that during their demo, they really have to behave as if it's real money. And a lot of people say they do that, but they really, really don't. For example, somebody might trade X amount of contracts on any given future contract, but in real life, they would trade a lot less, right? Or they might use time frames that are reasonable, in a demo, but they're not reasonable in real life. Let me use a very specific example. A lot of people say, I just want to trade one tick on the E-mini S&P. They just want to trade a lot of times the one tick minimum, which is $12.50. And I would say for a retail trader, it's impossible. It's impossible because you can't sit at home, and with the latency that you have, to go to the marketplace and do those kind of things. It's just, in real life, it's not practical. What you need is to have some sort of an automated program or some sort of an algo that sits on the server of the exchange, and you have to have exchange membership that would lower your commission substantially and so forth. But this is just one example. So it's important that when you trade demo, not to treat it as only a tool of demo, an imaginary thing, because the transition to real trading would have real important impact on your results. So you might see that the results in real life are not the same, and if you didn't apply it right on the demo, they will never be the same. So I would say that's important to do. Now, some traders just don't know those things. Unfortunately, it's lack of knowledge that makes them behave one way in a demo, and then in real life they expect to have the same, and it's just not the same. But I would say that that the difference when they transition, from demo to live, to a live environment, is to realize that when you have skin in the game, you have a completely different behavior when it comes to your money. Completely different. They can't expect the same results. I don't think you can learn how to trade through a demo. I believe that you can only learn how to trade with real live capital, because the emotional reactions in both situations is completely different. And because I believe in discipline and the psychological composition of a trader, I think that this is where you would basically see the difference in the two. So I think traders really have to realize that once they transition to a real live environment, it would not be the same. I think demos, for the most part, are there, in my opinion, just to learn the trading platform. It really is. It's where you learn the functionalities of the platform. So when you trade live, you don't want to use a manual or call your broker and say, where do I press this or where do I press that? You just learn over time, how to do things. Now, I'm going to say also another thing, which is another aspect, that periodically people who trade live, but they might test a method on a demo environment. Now, those who have traded live for many, many years or for many months, when they go back to demo, they, I would say, are more realistic about the limitations of demos. They already understand that if it works in demo, it doesn't mean that it works in real life. They test it in a fashion that works many times with the limitations of a demo. So when they move to real life, they don't have the same expectations. They might test certain things in terms of data. They might see if it's economically viable for them to do that. But again, their expectations and the way they approach demos are very different than those who never traded before.
Absolutely. I think that's a really valid point, and I can kind of relate to that on some level. Like, I remember when I very first got into trading, I was on a demo account, obviously, but it just didn't really feel right. I just knew that I wasn't treating it like I would if it was real money on the line. So yeah, after live trading for some time, and then I went back onto demo later on to try a different sort of methodology. And it was much more helpful after I'd kind of had a little bit of experience actually live trading. So yeah, it totally makes sense what you're saying there. Now, Matt, where do you see the future of trading headed? Like, where is our industry going? And maybe if you could aim this answer more towards independent traders.
I think the focus from retail customers and self-directed customers, I think the direction is going towards faster and faster connectivity to the exchange, low latency execution, and emphasis on the data. Today, retail customers, and I have to admit that some retail customers are very sophisticated I have come across retail customers that I've actually learned a lot from. They have been, for example, in areas of software and programming, and I'm not a programmer per se, and so I have some basic knowledge of some certain programming languages, but I've learned a lot from them how they look at the market. So I think the direction that we're going toward is faster execution, low latency, and also the ability to transmit unfiltered data. I think this will be a very important focus for a lot of technology companies out there. And I think this is what traders would demand from the marketplace.
Sure. Okay. Exciting times ahead. So,
Definitely.
Matt, are there any final words you'd like to add? I think we've covered a lot of ground on this episode. It's been really, really great. But are there any final words you'd like to add before we start to wind things down?
I would just say that, it takes a long time to be a trader. You shouldn't be in a rush. You really should filter the information out there. The more you talk to people who actually trade, and it's hard to find traders. For the most part, I find that people who trade, they don't advertise that they trade. You would never know. They always say that they do other things. But if you have a chance to talk to people who actually trade real live, and they apply it year after year, I think you can learn a lot from them. And I think at the same time, you have to filter also what you read on the internet. I've read or I heard in the next 4 years, the amount of information that will be on the internet will be 100,000 times more than the amount of information since the creation of Earth. I mean, can you imagine how much information there will be there about trading in every asset class? And you will go to the internet and you'll punch something on Google and you'll have articles and articles and articles, and you really have to, the difficult part will be to filter out what information will be there. Not only for myself, but for any, if you have an industry friend, try to talk to brokers like us who have been in the industry for a long time. We will give you practical solutions, and we'll be able to answer many of the questions that you have. And if you have a good relationship with your broker or somebody you can communicate with, this is a lot of the stuff that could cover. And so basically, I would say as a final word is really, more than anything, is to take it easy. The one very important thing that I would say in the end, that futures trading is a very risky business. You really have to trade it only with risk capital. I would really suggest to people that are very excited about the markets and want to participate and so forth, and I encounter those situations every day when people tell me, look, I have X amount of dollars, I want to put this much in futures. And many times I tell them, look, you can't. You really have to look at your overall financial situation and see if trading in leveraged product is your best bet to start with. There might be better asset classes that are better for you. But if you decide if you decided that futures trading is the area for you, take it easy. Filter out the information, learn the platform, and I would say also make a journal. When you trade in a real live environment, make a journal of what you trade and decisions that you have made right. Write them down. I would say the quantity that you write about your good trading should double the quantity of the writing that you do about your bad trading. Because what you want to do is get used to writing your good habits, and you reinforce your habits by writing more and more about them. It is important to make decisions when you make mistakes, and everybody will make mistakes, but at the same time, you keep track of everything that you do. You approach it in a very, very cold way. If there are times that you have periods that you did, that as I emphasized before, that you did everything right, but the market didn't deal you a good card, it's fine. It's something that happens to a lot of traders out there. That's basically it,
Awesome. Well, plenty of solid advice right there, Matt. Thank you very much for doing this. before you go, can you tell us a little bit about Optimus Futures, like who you cater to, and just a little bit more about your company?
Thank you. It's I appreciate it. So, Optimus Futures is an independent introducing broker. We trade through a number of clearing firms because we want to give our customers the variety to choose which clearing firm they want to go with. Along with every single clearing firm, there's also a lot of technology that they offer. So if people look on optimusfutures.com, they would see the number of platforms that we offer, and we help them choose which one is right for them. Along with that, we support them. We try to send them videos about every single platform. We're in communication with them in the early days to make sure that they get the username, the password, answer all their technical questions that they might have, and so forth. And above all, I would say my company is very, very patient. We're really like people. I personally, this is just my personal philosophy. I know that I make my living, it's a very conscious thought that I have, that I know that I make my living from other people taking risks with their capital. I don't think it's something that every single broker thinks about every day, and it's just kind of part of a job. Look, customers call in, you help them and they trade. But I think about it every day, how difficult it is to be a trader in this environment. In markets that are becoming more and more volatile, they are affected by algos, high frequency trading that has completely changed the landscape of trading. So trading as we go forward will be harder and harder. I don't think it will be an easy landscape to operate in for many people. We've especially seen that, just a small point, in the transition of where people had to move from pit trading, people who operated in the pits, to screen trading, and many of them were not successful in doing that. So I don't know if you've ever seen the movie Floored, but that movie emphasizes that. So I always keep at the back of my mind how difficult the environment is for traders. And so I try to help them as much as I can, provide them with all the tools. And the same goes for my staff. They're really nice people. They really operate also from that philosophy because I enforce it every day. And again, you can find the rest on optimusfutures.com.
Excellent. So optimusfutures.com. How else can people get in touch with you? Are you active on Twitter?
We have a Twitter account. It's Optimus. I think it's up at Optimus Futures. People can always email me. I always get my emails on my phone and my laptop when I'm not at work. I answer emails at night. It's Matt at optimusfutures.com. And they can call us toll free. It's 1-800-771-6748. Our local number is 561-367-8686. And they can also, through Skype, Optimus Trading Support. If you're an international customer and you're interested in getting in touch, we'll help you out.
Excellent. Okay. Well, I'll make sure to include links to all the details you just shared there in the show notes. So those show notes can be found at chatwithtraders.com/56. Everything will be there in one place. Now, Matt, I should have asked you this before we even jumped on the call. I know you're a busy man, but are you open to answering more maybe general questions that any of the listeners may have in the comments? Maybe something around brokerage questions or questions, even about trading.
Absolutely. I always enjoy talking to people. I find that, I never lack the enthusiasm to explain the same thing, even if I have to do it 10 times a day, if I have 10 beginners that day, or if I have 10 advanced traders or looking for better technology, even if the answers that I provide are repetitive, I always do it. And I wanted to tell, specifically, Aaron, that I really, really like what you do for traders. When I started out, when I was probably in my 20s, I don't think that people around our age group at the time took the same initiative that you take today to help people. And I think what you do for the community out there, bringing industry people and giving them a realistic perspective about trading, I think it is so educating. And I think a lot of people, maybe that's one of the good things about the internet. There's so much information out there, but periodically there's a person out there like you who has really good intentions, who is very organized, puts things in an organized manner where people can actually listen to all those interviews, take notes, and come with realistic expectations to the marketplace. So that's one good thing that happened with time. That I find that young people like yourself have a lot more skills than what we had back in the day, when we started in the business.
Well, thank you very much, Matt. That means a lot. I really do appreciate that. So thank you. So guys, if you do have questions for Matt about anything at all trading related, go to chatwithtraders.com/56, scroll to the bottom of the page and leave your question in the comments area. And Matt will be obviously keeping a close eye on that, as will I. So, all right, Matt, absolutely awesome to have you on the podcast. Thank you so much for doing this. I know we'll be staying in touch, and we'll talk soon.
Absolutely. Thank you for the opportunity, Aaron. Much appreciated.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders, episode 55.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
What's up, guys? Welcome to episode 55, and thank you very much for tuning in. I'm your host, Aaron Fifield, and this week on the podcast, I interview Nathan Michaud of Investors Underground. Nate has been a day trader since 2003, and the stories from his first few years in the game are enough to make your head spin. After experiencing major highs and lows, both financially and psychologically, which is all covered during the interview, he's gone from strength to strength playing small cap momentum stocks. Over the next 60 minutes, you'll learn about Nate's approach to fast-moving stocks, the additional risks linked with short selling, a smart way to scale up, the power of compounding, and heaps more. Full show notes can be found at chatwithtraders.com/55. And for educational material and ongoing support from the Investors Underground community, go to chatwithtraders.com/IU for a discounted rate. All right, team, enjoy the interview. You're listening to the Chat with Traders podcast, and here is my guest, Nathan Michaud. All right, Nate, so great to be speaking with you. Thanks a lot for coming on the podcast. How's it going?
Great. How are you doing?
I'm doing really well. And Nate, we've had so many requests from traders listening who wanted to hear an interview with you. So I'm glad we could make this happen. And from what I hear, the last few weeks have been pretty chaotic for you. What's been going on?
They have. I mean, we've been, ever since we did the Vegas event for Traders for a Cause, we came right back and then we get right into the swing of things. And we just did the first annual gala at Tuscan Kitchen in my hometown area. And we did that with about 200 guests. We raised about $20,000. We presented a check to On a Flight to New England for $45,000. And it turned out to be a really great success. But now we can finally relax a little bit. And that's kind of why we're doing an interview right now.
Awesome. That's great, man. And Michelle Koenig, who I know is a good friend of yours, had plenty of great things to say about Traders for a Cause. She was on the podcast a few weeks back for episode 44. So that was a lot of fun. I'm sure we'll speak more about this later in the interview anyway, but let's get started. So Nathan, how did you get started trading? Tell us, where did everything kick off for you and what year was this?
This was back my freshman year of college, and it was really about, at first I wanted to be potentially a broker. I had seen my uncle, who was very successful, lived a pretty good life, and I was very interested in that. And everything that I knew came from him. It's okay, stocks is where you need to be, so that must mean I need to be a broker. So I started to focus towards the broker side of things. Is that something I want to do? And I started to get this interest for stocks, and it was really just trial and error my freshman year back in 2000. A stock had earnings that I had bought, had no idea. I was up a couple $100 and literally been addicted since that day.
Sure. Okay. So you mentioned right there that your uncle had kind of inspired you in the early days because he was also a stock trader. Did he help you out in any way?
He was more of an investor. So, I knew that he had done well in the stock market in general and not necessarily as a day trader. He actually now is more active than he ever was, trying to just make a couple bucks each day, just having fun in his sort of semi-retirement. But it was more of here's what's possible. And there is something more than just that 9 to 5 or working for somebody or doing something else for somebody else's dream. And with more of that entrepreneurial type spirit.
Right. Okay. And when you first got started, what was it that would give you reason to buy or sell any particular stock? Like what sort of things were you looking for in the early stages?
If you go way back to 2003, 2004, I mean, it was so much different than it is now. I mean, it was all about the story, and stocks would literally run. And keep in mind, I was trading OTCs back then. So you're talking about stocks that were 001, 005, and they would literally run to 20 cents.